morning, everyone, and thank you for joining us this morning for our webinar on Scarp, What We Know So Far. I'm Laura Michelle Moore, and I'm a Technical Manager for the Professional Accountancy team at Chartered Accountants Ireland. I've worked myself in insolvency for many years and have a keen interest in this process. We would like to welcome our guest speakers this morning, Des Gibney of McStay and Hilary Larkin of Mazars. Both Hilary and Des have many years and a wealth of knowledge in the corporate recovery and insolvency sector, and both have many years' experience and a wealth of knowledge in formal insolvency appointments and both formal and informal restructuring. To start with, Des will take us through an overview of the Scarp process, and afterwards Hilary will take us through some practical considerations on what to do for those considering Scarp and what to look out for. Towards the end of the hour, Des and Hilary will answer some of your questions on the Scarp process, so please feel free to use the Q&A function to send through some questions, and we'll answer as many as we can. I'm now going to hand you over to Des firstly, and I will see you at the end of the session. Thank you very much.
Thanks, Laura Michelle, and welcome everyone. Thanks for joining us this morning. Apologies for the technical difficulties that we were having earlier on. However, that's technology. As Laura Michelle said, I'll give an overview of the process and a little bit of background to the legislation. I happen to be heavily involved with restructuring and insolvency Ireland over the last 10 years or so. We had a ringside seat, I suppose, for the correspondence between the department and the company law review group, which led to the formulation and enactment of the Scarp legislation in December 21. Anyway, Scarp. So where are we to date? The legislation came in really it was enacted in late February, early March 2022. So we're really only 8 to 9 months into the I suppose the availability of the procedure. At the moment, our first slide there, we've 21 appointments nationally. Now 9 of those are currently ongoing, so half the appointments to date are still in train. 5 have successfully concluded, 3 with no rescue plan formulated, and 2 currently in the 21-day cooling off period. Now, I suppose the Scarps of note to date, the largest one that's been reported in the papers was the Kerry-based RCC engineering firm that had 70 employees and recently successfully exited its Scarp. Managed to secure an external investment of €800,000 from Priority Construction in Dublin. And that investment would have funded a scheme which we understand provided 100% dividend to the secured lender. It was Bibby Financial in that case, and the super preferential, which would be social insurance deducted from employees' wages but not paid over to revenue. Preferential creditors such as revenue amounts owed to them within the last 12 months prior to the Scarp commencing got 20%, and the unsecured creditors got 7.5%. Not a bad result when you consider that most liquidations would result in creditors getting little to nothing. Other companies of note were the companies behind Dylan McGrath's Rustic Stone, or Scarps of note, and Bros 366. I see from the filings in the CRO that they exited their Scarp process in September of this year, and they were widely reported in the media. So that's what it's still new. It's still fresh. There's only 21 ongoing. I think there's a lack of awareness out there that the procedure is available. And look, I think it was a slow burn with the examinership legislation when that was enacted initially, and it was a reluctance for companies to go down that route. But it seems to be gathering momentum, and I think the more that the procedure is, I suppose, advertised and awareness gathers, that the more hopefully it will be used. Notably, 50% of those companies that have gone into the Scarp process are from the hospitality sector, which for obvious reasons these days is experiencing a tough time. So what is the process, and what does it stand for? Look, simply put, it stands for Small Company Administrative Rescue Process. It's a bit of a mouthful. What is it though? Simply put, it's a formal restructuring tool aimed directly at small and micro companies, and it provides a framework, a legal agreement, whereby that company can come to an arrangement with its creditors, which allows it to continue to trade and avoid liquidation. And that's probably as simply put as you can describe the process. The company has to meet a couple of key criteria in order to avail of the procedure, and we'll discuss them a little bit later on in the presentation. Probably the most key element is that the business has to be viable. There has to be a business going forward, subject to the restructuring plan that's agreed with the creditors, and there has to be investment available to fund the Scarp scheme, pay the dividend, and indeed to fund the working capital that the company will require to last beyond the Scarp procedure. And if that's not there, then really the company is probably not a candidate for Scarp and will be looking at alternative options such as liquidation and so on and so forth. And there, so that, like, the key criteria, a smaller micro company is set out under the Act must satisfy two of the following 3 points: turnover not exceeding 12 million, balance sheet not exceeding 6 million, and less than 50 employees. So if it satisfies two of those, then it does qualify technically in any event, subject to having a viable business plan and funding to see it through. That's the procedure, the definition described. Now the background, which hopefully members will find of interest, and how it came about, was, I suppose, I had a ringside seat on Restructuring and Insolvency Ireland. We have as the umbrella organisation that represents insolvency practitioners in Ireland. We have a representative on the Company Law Review Group, and for as long as I can remember, there has been discussions and thoughts as to how the examinership legislation could be either amended or adjusted to make it more suitable and less expensive for smaller companies. It's widely acknowledged that it is a formidable restructuring tool, but given the high level of court supervision and the external advisors that are required in that process, it leads to it can be quite long and it can be quite expensive, therefore making it prohibitive to smaller companies. That dates back as far back as 2012, when the CLRG had a paper discussing amending the actual existing legislation, examinership legislation, but it was thought just too cumbersome to exist. What was there, albeit what was there was actually excellent. Fast forward to the pandemic, 2019, and the Minister for Business, Enterprise and Innovation, it was Leo Varadkar at the time, wrote to the CLRG and asked them to consider a rescue mechanism suitable particularly for smaller companies, akin to the examinership legislation, that would give a formal restructuring tool for companies that are obviously not in March 2019, when the pandemic was starting, experiencing difficulties, but would no doubt in the coming period hit financial difficulties. The CLRG considered the matter. There was an insolvency subcommittee of the CLRG established. A lot of insolvency practitioners from around the country would have been co-opted onto it in order to provide their input to the mechanism that would be most suitable. And in a report back to the Minister in October 21, they concluded in their report that any new tool should be distinct from examinership and have a separate name. Hence the name we have. It should be aimed directly at smaller companies as defined in the Companies Act, and we just covered those criteria in our previous slide, and should commence by way of a resolution passed by the company, as opposed to a court application, which is obviously slightly more cumbersome. There's legal representation required, there's affidavits, and then there's an independent accountant's report also required when commencing the examinership process. Much more slimmed down under Scarp. They concluded that it should the period should be shorter than examinership, which it is, and it should commence and be overseen by a qualified insolvency practitioner. And we'll talk a little bit about those qualifications in our next slide. They recommended that the cross-class cram down of creditors be maintained, and by that we mean in any examinership scheme or Scarp scheme you'll have various classes of creditors, be they unsecured, retention of title, preferential, landlord class creditors, and once one of those classes votes in favour of the scheme then becomes binding on all of the other classes, which we refer to as cross-class cram down. They recommended that the scheme be approved without the need to make an application to court, and that legislation was inserted into the Companies Act 2014 as Part 10A. And comes in after Section 558, which is how the Scarp legislation came into being. That report went back to the minister, and the legislation was largely drafted up in line with the recommendations, with a couple of additional pieces, and that's how Scarp came into being. It wasn't really until the pandemic hit that the requirement became urgent to facilitate that mechanism for smaller companies. Now, the legislation is largely taken from the examinership legislation, but there's a couple of key differences there, which our next slides just highlights, and those key differences are the things that make it shorter and less expensive, and I'll talk you through some of the key ones here. Under examinership, there's it's open to all companies, even though it's not going to be suitable for smaller companies given the costs involved. Scarp is only available to small and micro companies as set out in the Companies Act and described previously. A Scarp starts with a resolution that's passed by the company, whereas an examinership starts with a petition typically made by the company to the court. That petition will be grounded with affidavits and would also be accompanied with an independent accountant's report. So there's quite a lot that goes into an examinership application, and that'll give you an understanding of where the costs start to creep up. There's no difference in the day-to-day control of the business under both procedures. Both remains under the responsibility of the directors. The Scarp period lasts for 49 days with a 21-day cooling off period, whereas examinership is 70 days, which is typically extended up beyond 100 days by way of a court application, and can be extended beyond that at the discretion of the court. Slight difference in the thresholds for creditors voting in favour of the schemes. Under examinership, one class of creditor needs to vote for the scheme being a majority in number of creditor representing a majority in value, whereas under Scarp it's 60% in number representing a majority of value. Not much of a difference, but a slightly higher threshold required to approve the Scarp scheme. Repudiation of contracts is available under both arrangements, and it's probably more prominent under examinership, as has been widely reported over the years. Under Scarp, it is available. There's a mechanism there that allows the process advisor engage with the other party on the end of the owner's lease or owner's contract, which 9 times out of 10 will be a lease. And there is a process whereby the process advisor can engage with the landlord. The landlord can recommend alternatives to make the agreement more viable or affordable for the company. However, I would say that if a company's main aim is to use the process to repudiate a lease, it's probably not the process to use. If a company is having difficulties with an owner's contract, it will be better off sorting that out prior to a Scarp commencing, and maybe finalising or formalising the agreement with the landlord or the other party through the Scarp. So you could agree a reduced amount of rent or repayments, a write down in the amount that's outstanding, pre-Scarp, and then formalize it by way of the Scarp. So essentially it's been done on consent. There are no excludable creditors in an examinership, and as we'll talk about later on in the presentation, there are excludable creditors under Scarp. They are state creditors, namely revenue, that have the option to opt out of the process. And I suppose what is key is that any company considering a Scarp is up to date on their revenue returns, and they have a good working relationship with revenue. They may owe revenue for a VAT, PAYE, whatever it is outstanding, but it is key to make sure that you have engaged with revenue and that all your returns are up to date, because there is an option there if for a rogue company that's not on side with revenue for revenue to opt out. Having said that, all the experience to date amongst insolvency practitioners around the country is that revenue have been very supportive of the Scarp procedure and have participated in practically all the schemes to date. So that's telling. I think revenue are going to support this new process going forward. The last key difference here between the Scarp procedure and the examinership is the automatic stay on proceedings from creditors. Under examinership, the company gets immediate protection from its creditors as soon as the application is approved by the court. No creditor can take action against the company to wind it up. Under Scarp, that's not the case. That the creditor still can bring winding up proceedings against a company to enforce its debt or its security. However, the process advisor can make an application to the court for protection if that happens, and then it's determined by the court whether or not the creditor is allowed to proceed. And I would suggest if a company is in Scarp, that 9 times out of 10 the court will agree and give the company the breathing space to pull a rescue plan together and see if it can get the approval of its creditors. So that's a little bit about the background to the process and the main difference between it and examinership. Moving on to the process itself, our next slide here, it's a little roadmap, and it says there on it that there's 8 steps, but really there's 2 critical parts to this procedure. You have pre-Scarp and you have post-Scarp, and Hilary will talk a little bit about the planning involved in the pre-Scarp stages, but the key elements and probably the majority of the work will be done in the pre-planning stages. The key parts for a company considering this is that it has a viable business plan subject to an agreement with its creditors, and that it has an investment funds to fund a Scarp, or it has the wherewithal or access to the funds to sustain it throughout the Scarp period, which is 49 days up to 70 days with the cooling off period, and has the ability to sustain itself after that, and can demonstrate that it is a viable business. And lastly, the planning will involve the collation of its creditors' ledgers, ensuring that the amounts outstanding are correct, email details are on file, and that is as comprehensive as possible, because once the process starts, there's very little time to involve in getting those details correct if they're not already there. So to talk you through a whistle-stop tour of what the process might entail is, firstly, the company will meet with their qualified insolvency practitioner. They will say, look, we're undergoing financial difficulties here. We think we've got a business, but we simply can't pay this legacy debt for whatever reason. We have some funds, or we have an investor lined up that's willing to get involved. And do you think this process is suitable for us? The potential process advisor at that stage will look at the statement of affairs, which has hopefully been produced, and will look at the business as described by the directors. If they determine then that it is a suitable candidate for the Scarp process, the PA then drafts a detailed report setting out the reasoning for the company's suitability and gives this to the directors. The directors then have 7 days in which to pass a resolution appointing the process advisor and commencing the procedure. So it's once that that resolution is passed, the clock starts ticking, and we're into our 49-day period. A couple of key things that have to happen immediately after that appointment. Within 2 days, notice of the appointment has to be filed with the CRO. The resolution, the process advisor's determination and report, and the court determination is also filed with the court as determined by the process advisor. And essentially what the process advisor is doing there is filing those documents with the court. It's probably going to be a circuit court in order to keep costs down. But if there's any requirement to go to court throughout the 49-day procedure, there's a reference number given, and creditors can use that in any applications, as can the process advisor. Directors have to place a notice of the appointment in a prominent place on the company's website, and the appointment is then advertised in Iarshifigul. We're into then the kind of the nuts and bolts of the process advisor commencing pulling the scheme together and liaising with the company's stakeholders to get the required information back in and be able to input it into the scheme. So within 5 days, the process advisor has written to the members, employees, creditors, revenue commissioners, and requested all the information that they're going to need in order to formulate the scheme. The creditors then have 7 days to acknowledge receipt of the notice and 14 days to come back to the process advisor with all the information. Now, the process advisor at this stage is under time pressure, and where, as will likely be the case, a lot of creditors just don't engage. There's a mechanism there that allows the process advisor to determine the amount of debt that will rank in the scheme, and that's really to facilitate the process advisor being in a position to pull an arrangement together where there isn't cooperation, or there's simply just there's nothing coming back from creditors. Where there is excludable debt involved, the revenue have 14 days to come back and opt out. There are criteria that they can opt out under. Hilary will talk us through those later. But that has to happen within 14 days of the process advisor writing to revenue. Other items that might be considered throughout the 49-day period is the repudiation of relevant contracts. As said, that will probably be agreed before the process in all likelihood, but if not, in order to repudiate, it's a legal application that's required by the process advisor, and that will have to be taken during the period, and time pressures associated with that will apply. So the rescue plan is pulled together, and what might a rescue plan involve? You might ask. Well, it'll be a fairly substantial pack that will go out to all the creditors. This can all be done by email, which is all of the notices, which is obviously a key tool in ensuring that the 49-day period is adhered to. But the rescue pack will typically have the statement of affairs of the company. It'll set out the result for creditors and stakeholders on a winding up or receivership of that company, and it'll compare it to the effects under the Scarp and what the outcome will be, and that will always show that the Scarp will be a better outcome. For obvious reasons, a company can't do, or the creditors can't do worse, or shouldn't do worse anyway, under a Scarp procedure than they would in the event of a winding up or receivership. And Hilary will bring us through that later on. The plan will set out the reasons why it is fair and equitable to creditors, and it will set out the remuneration of the process advisor. That all has to go out by day 42. It can go out before, because 7 days clear notice has to be given to creditors to hold the meeting by day 49. Once the meetings roll around, the scheme is approved when one of the classes of creditors votes for it, with a 60% majority in number and a simple majority in value. That scheme then becomes binding on the rest of the creditors. After that meeting, there's a 21-day cooling off period where any creditor who feels that the scheme is not fair and equitable can make an application to the court, and it will then be up to the court to determine whether or not the scheme is fair and equitable and approve it or not approve it, as the case may be. So the appointment, the process advisor, their appointment is then terminated when the rescue plan either takes effect after the 21-day cooling off period, or if it's not approved at the meeting of creditors, then the company's out of Scarp. It reverts back to the directors, who then have to deal with it. Our next slide then just sets out the timelines involved. Really have been described there on the previous slide, and the key one there being day 42, process advisor calls the meetings of members and creditors to approve the rescue plan. So that's a whistle-stop tour of the procedure and the background to it. I hope it's been of interest, and I'll pass over to Hilary, who will bring us through some of the practical implications. Thank you.
Perfect, thanks, Des, and good morning, everyone. So I guess there's an amount of technical detail in what Des has presented. So what I've sought to do is to try and summarise the practical conclusions and considerations if you're looking at Scarp in your own case, or indeed if a Scarp case has come across your desk in the capacity as a creditor. And then I'm going to go through a quick case study to give you a feel for what it actually looks like, or the impact on the balance sheet. So the first thing to take away from this slide is the importance of planning. It's a really short timeline in that really it's only 49 days once you exclude the 21-day cooling off period. So it's really important that there's adequate and appropriate planning done before the process kicks off. This is going to be done really as part of the preparation or the pre-planning report with your process advisor. And the first thing that you need to look at is updating the financial information. You really need well thought out projections that reflect the current position of the business, the current run rate, and the projections that will give you a feel for the week-on-week capital requirements of the business throughout the 70 days. Because one of the really important things of Scarp is that the business needs to be able to fund itself through the process. So that will underpin the viability argument. You need to also assume that all creditors are going to be operating on a cash on delivery basis only. And the fact that you're in this process at all means that your credit terms are going to be null and void. So you need to be prepared to operate on a pay-as-you-go basis. There's going to be a number of essential creditors or pre-appointment liabilities that are critical to the business, and they're going to have to be paid. So that's going to have to be factored into the cash flow. So this is things like your utilities. You're going to have to keep the lights on to keep production going, or creditors who have an ROT claim are going to have to be paid. So even though you're in a process that crams down or impairs liabilities, there are a certain cohort of essential liabilities that are going to have to be paid and factored into your cash flow. So obviously, if you're going to be operating on a cash on delivery basis, then your working capital cycle is going to be different to normal. And so again, this needs to be factored into your figures. If you have an invoice discounter, they may or may not support you during the period. So you need to factor that in, and the implications of a scenario where you can't release cash from your debtor book. Once you consider all these various matters and you finalise or you conclude on your projections, that will really give you a feel for the funding requirement during Scarp and what the investment amount is likely to be to take you out of Scarp. So the investment amount is going to be the funding requirement for your working capital, your process advisor costs, and your dividends. So you need to pull all these together at the outset of the process, and you need to understand or figure out whether or not you have a line of sight on investment, whether you can fund it yourself or whether you can get an investor. Because if you don't have a line of sight on that funding before you embark on the process, it will be risky as to whether or not it will be successful. So overall, you need to be able to demonstrate in the planning process that the company has the ability to fund itself, and that the underlying business is actually viable. The attitudes of your key stakeholders are going to be really, really important here. So we're talking about creditors, revenue, the financial institutions, if you've got secured debt, it's really, really important that you engage with them, you find out their attitudes, if they're likely to view the process negatively and cease supplying, and you need to understand then the implications on your production chain and whether or not you're going to have the ability to service your customers during the process. Again, that will question whether or not the process will be a success. And as Des touched on, your history with revenue and their likely disposition to the process is really important. They're defined as an excludable creditor, which means they have the ability to opt out of the process, which would mean that their debt wouldn't be crammed down in the process. And oftentimes, it's the main debt that people need to get written down in the process. So you really need to have a good understanding of your tax history. If there's an ongoing revenue audit, or if there's been a recent one. So if your tax history is checkered, then it is important to know that at the outside, because rather than getting into the process, incur the costs and find it to fail. So finally, if you on the planning side, if you have a secured lender, the attitude of that lender to the process is really important. The process can remove the secured lender's position, or the secured lender can appoint a receiver if they hear that a Scarp is underway. They might get spooked and go ahead and appoint a receiver. So in my view, it's really, really important that you engage with the lender in advance of embarking on the process, have an open and transparent discussion, explain where you're coming from. In many cases, in any event, you won't be looking to compromise the secured debt, because there'll be value in the security. So it's important that you have that conversation with the bank, because the last thing, they don't like being the last to know, and it's important to give them a heads up beforehand. So another important consideration is creditor engagement. I've mentioned already the importance of talking to creditors and getting them on board, but it really can impact on ongoing supply and have a knock-on impact on the business. In Scarp, we really recommend that there's lots of engagement with creditors, and that it's timely, regular, open and transparent. You should be explaining to them where you are, what does the process mean, the likely haircut amount on their debt, and what the business is going to look like afterwards, to give them some kind of comfort around the process. It's important that creditors don't feel like there's anything hidden or anything that they're not being told. I always favour open dialogue, continual updates throughout the process. Remember, if you do that, and if you're transparent and accountable throughout, then you're likely to reduce the amount of objections that you get. It really is, the whole process really is a matter of bringing your creditors along with you. I can't overemphasize enough the importance of that, because those objections have the ability to delay the process, add costs because it will require court involvement, and ultimately derail the process if they are successful. So it's important to minimize them where possible, and good, robust engagement with them really can go a long way in that regard. So then moving on to excludable creditors, I know Des has touched on that. That's really revenue and other state creditors. They have the ability to opt out of the process, so that their debt won't be able to be crammed down as part of the restructuring through Scarp. So they can do that if there's a history of non-compliance, or if there's an ongoing revenue audit. So it's important to have an educated view based on your particular circumstances, or whether or not they're likely to support you. If revenue are not on board, it really will undermine the business case for entry to Scarp. On the next slide, then another important consideration is the court jurisdiction. You may not at the outset of the process have a line of sight on whether or how much, if any, court involvement is required. In theory, it is possible, and it has happened in certainly in the case that we worked on, to get through the process without court involvement. But for other cases, you may need court involvement if a creditor action, such as a bank seeking to appoint a receiver, if you need to repudiate or vary the terms of release, or if you have to deal with creditor objections. So say if you do get an objection and you have to go to court, the jurisdiction that you select is important, because really the circuit court versus the high court are two very different animals. If you go to the circuit court, you may be exposed to the vagaries of the court, which means you may get a judge that is more criminal than commercial, and you might run the risk that you might not get a decision on commercial matters that relate to the issue at hand. There's also the timing issue of getting a slot in court, which may be slower in the commercial court, and that again can impact on your Scarp timelines. Having said that, you also do need to be mindful of the cost of High Court and the implications of that on the potential dividends for creditors. So the next important consideration to look at is onerous contracts. And the main one that comes up here is leases, and leases and rent arrears may well be a reason in many cases that Scarp is selected by a business. So the one thing I would say on that is that leases can be repudiated or varied under Scarp, but it will require court involvement, and that's whether the landlord consents or not. Obviously, if the landlord consents, it'll be it'll be just a procedural matter. It'll be straightforward. If the landlord disputes it, then you can run into significant costs that might, if it's a small business with a small amount of investment available, that may eliminate them from the process. So therefore, a chat with the landlord, understanding where they're coming from and try to reach a compromise with them can really copper fasten the likelihood of a successful outcome from Scarp. And then the last one is guarantors, and this is one we always get questions on, and it's the position of guarantors either in examinership or Scarp. So it's really important that people understand that if you have personal guarantees out against a lease or a debt, then the rescue plan doesn't affect the personal guarantees. That means that even if a rescue plan is successfully implemented, the personal guarantees will remain after the process. So I would say if you're a secured lender or someone relying on a guarantee and you want to pursue the guarantor under the guarantee, it's absolutely important and critical that you give the guarantor the opportunity to vote at the creditors' meeting. So if you are the lender or you hold that guarantee from somebody and you vote at the meeting, then it will undermine your ability to pursue the guarantee after the process. I can't emphasize the importance of that point enough. So as a creditor, you really need to be getting advice on this for the meeting, and once you're notified that the process is in being, to protect your own position. So they are the practical issues that I would see as the main issues that really need to be considered if you're thinking about embarking on Scarp. So they are planning, creditor engagement, knowing where you stand with revenue, how to deal with onerous contracts, and the guarantee position. These are all practical conclusions or considerations that you really need to get a good understanding on before you decide to embark on the process. So then just moving on to the next slide. Okay, so what I've sought to do here is to bring together some context of the legislation and to show you a very straightforward basis as to how Scarp works, what does it mean on a distressed balance sheet, and what the balance sheet might look like when it comes out of Scarp. So this is a really straightforward example. It's a company with a turnover of 2 million, total assets of 1.75 million. So that's important to note that that's total assets rather than net assets. Sometimes people get confused about the criteria in that regard. And then there's 10 employees. So in order to qualify for Scarp, you must, for 2 years running, be deemed to be a small company, which means that you must have turned over less than 12 million. Your total assets must be less than 6 million, and you must have less than 50 employees. So you must not exceed 2 of these 3 criteria in order to qualify. It's really similar to the audit criteria exemption. So a quick rule of thumb is if you're audit exempt, you're definitely going to qualify for Scarp. In this case here, the company ticks the boxes on all 3 criteria, so it does qualify for Scarp. The company has also ascertained that they had a viable business before COVID, and they're happy now that there still remains an underlying business post-COVID, but there's some legacy liabilities remaining in the company that have accrued over the intervening period that need to be resolved in order to put the company back on solid footing. So if we look down through the balance sheet here in fixtures and fittings and buildings is 1.75 million. Current assets then comprising of stock, debtors and cash totaling 685,000. Current liabilities of 2.5 million, including a bank loan of 900,000, which will be secured against the buildings that are valued at 1 million. So if you strip out the bank loan, then you're back to current liabilities of 1.5 million, which when compared against current assets of 685,000, it's really clear to see that there's a liquidity problem within the business, and they meet the insolvency test. So when the current assets exceed, or sorry, when the current liabilities exceed the current assets and there's an overall deficit in the balance sheet, then the company is deemed to be technically insolvent. So it's really important that you meet that criteria when you're embarking on the process. You need to be able to demonstrate that in order to qualify. So I suppose to summarize, in this case, the company qualifies for Scarp because it's defined as a small company under the Companies Act. It's met three of the three criteria. It is it's technically insolvent based on the balance sheet test, and the underlying business is viable, so it can qualify for a Scarp. So just moving on to the next slide, we can see the impact of Scarp on the business. So what I've sought to do here is to set out the business in terms of statement of affairs under three scenarios. So on the left-hand column here, you can see the pre-Scarp basis, and that's what the business currently stands at. Then in the middle column, I've set out what the outcome would be, or what the statement of affairs would look like under a liquidation scenario. And then on the last column on the right, it's how the statement of affairs would look in Scarp and how the creditors would fare. So the underlying premises of Scarp is that creditors must always fare better than they do in liquidation. In examinership, for example, if this criteria is not met under the process, then the default position is liquidation. Liquidation isn't automatic in Scarp, but it most likely will be the recommendation of the process advisor if a rescue plan is not put in place. The recommendation, it doesn't have to be implemented by the promoters, but if it's ignored and ultimately the business does go into liquidation, then their conduct may be reviewed by the Director of Corporate Enforcement, and they could end up being restricted from acting as a director. Okay, so if we run down through the various components of the balance sheet here on the statement of affairs, we can see that land and buildings, if the net position there is 100,000. So that is after accounting of an asset value of 1 million, less the bank debt of 900,000. The outcome in liquidation for that will be that the bank would most likely appoint a receiver, realise their debt, and there'd be 100,000 then broad terms left for the liquidation fund. The position in Scarp then would be that you'd speak to the bank, you'd advise them that their debt would remain whole, and that you'd hope that they wouldn't take any action, and then the outcome it would remain the same for Scarp as it would be in liquidation. So that would be 100,000. If we look at fixtures and fittings, then in liquidation they would be sold and probably at a discount. The amounts due under finance leases will be either handed back or sold, and we estimate that there will be a net outcome of 5,000, and that's after the discount will be applied for selling them. In Scarp, then, similar to the land and building situation, it's most likely that an agreement will be reached with the finance lease provider whereby payments will probably be suspended during the process, and then they will be resumed in full post Scarp. So on a net basis, there'll be no difference in the estimated value of 25,000. Then if we look at debtors, in this case, there is an invoice discounting facility in place. So the current net position on debtors after the invoice discounter is paid is 200,000. It's likely in a liquidation scenario that there will be difficulties in collecting some of these debtors. There always tends to be, from my experience. So we've estimated the debtor book value would realise an estimate of 60,000 in liquidation. On Scarp, because the business will be trading on, the invoice discounter balance is kept whole, and it continues to be collected during the process. There's no change in the value of debtors during Scarp. Cash at bank then remains the same throughout the process. And stock, we have looked at that on a liquidation basis and have assumed that there will be a write down in stock, that ROT or retention of title would have to be repaid, and maybe there'll be a discount applied in realising the stock. So we've estimated the net realisable value there at 37,500. Again, in Scarp, there'll be no change in the asset value because the business continues on. Creditors are paid as cash on delivery, and no discount would apply to the value of stock. So when you look at the asset side of the balance sheet pre and post Scarp, you'll see that there's no difference because the business trades on a Scarp and all debtors continue to be collected, stock continues to be turned, ROT is being paid. So there's no change on the asset side. So really, it's on the liability side where everything changes. So you take the net realizable value of the assets, which sets the baseline for what the creditors will be entitled to in a liquidation scenario. And that is a starting point for the dividends that you'll be entitled to in Scarp. If we look at this net realizable asset value in a liquidation scenario, you can see that the liquidator is estimating that they're going to realize 212,500. You can see that there in the middle column. And that will be from the sale of the assets and factoring in the various discounts that I've mentioned and repaying your invoice discount or your finance lease, the bank. So that's your starting point for liquidation. Then you got to pay the liquidation costs, which are preferential in any liquidation, and we've estimated them at 40,000. So that leaves 172,500 of funds for the liquidation, and that's what would be available to the creditors. So in order of priority in this scenario, the first and only creditor that would get a dividend is revenue, and that's given their preferential claim. So here you've got a total revenue liability of 325,000, of which only 200,000 is preferential because that's the amount that fell due within the last 12 months leading into the date of liquidation, the date of Scarp. The balance of the revenue debt then falls into the unsecured bucket. So in this scenario, we've separated out, or we've stripped out the preferential revenue debt from the overall revenue debt and the breakdown of the creditors on the workings there. So revenue get the full 172,500. They get nothing on their secured debt, and moving down through the other class of creditors, the unsecured loan realizes nothing. The trade creditors, they get their ROT back, but they don't get anything on the balance. So this is the starting point then for Scarp. So the creditors must get more than 172,500 in Scarp. So the revenue must get more than that, and the unsecured need to get more than zero. So at the start of the process, when you're planning, the process advisor looks at this scenario and has to conclude that they have a line of sight on sufficient investment that the creditors will get more than 172,500. And if they can't see that, then there's really no point in going down the route of Scarp. So in this example here, we're assuming that the unsecured parties will be given a modest dividend of 3%. The dividend range from unsecured parties in these scenarios can range of anything from 1.5% all the way up, but it's usually a relatively modest figure, somewhere between 3 and 10%. So in this scenario, we have increased the preferential dividend by 3%. So the prefs are doing better at 177,675. We gave the unsecured revenue liability, the unsecured loan, and the trade creditors their 3%, bringing it up to 197,000. So if you run down through that, the creditors are getting 197,000 in Scarp versus 172,500 in liquidation. So technically they're doing better, and you can put forward a rescue scheme for approval to the creditors. And the net effect for your business is that the balance sheet moves from 290,000 of a deficit to a positive position on 235,000. So really there's been a swing of about 525,000 as a result of Scarp, which is a really positive thing for a business. And this is after writing down revenue by 145,000, writing down your unsecured loans of 97,000, and writing down your creditors by 313,000. So really the balance sheet has been completely right-sized by over 500,000, and this has been done after paying the process advisor their fees of 30,000 and the total dividend of 194,000. So what I would say in terms of managing your investment amount is that you most likely will be able to agree an installment arrangement with revenue for the 177,000. An upfront payment of some sort will be required, but in broad terms, you could assume that the revenue debt will be phased out and an installed arrangement which will reduce your upfront funding requirement. So that figure obviously takes into account, that figure is before you take into account your working capital requirements. So that's going to be depending on your cash flows for the period, what your working capital is running at, what you have to pay stock, your pre-petition liabilities, So you need to have worked that out before you embark on the process. So if you assume in this case that we're talking about needing 46,500 to pay your upfront, to pay your costs and your unsecured dividend, then say you give a 50% advance on the revenue debt, and you need a 50,000 advance on the revenue debt, and say you need 50,000 in working capital to fund the business through the process. All in all, you probably need to raise about 150,000 of investment on a €2 million business. So if you're to look at the downsides of the process, it's the promoter's ability to raise those funds. But given that there's such a transformational effect on the business, on the balance sheet, I would imagine that a lot of promoters will find the money, because it absolutely makes commercial sense, particularly when there's a viable business and you've line of sight on trading profitably out the way. So I'm just conscious that we're running a bit behind schedule, and I hope that, and I appreciate that I've gone through that very quickly. So if anybody does have any questions, we're going to run a bit of a Q&A now, but if anyone wants to take it up on a one-on-one basis, I'd be delighted to assist in that regard.
Thank you to Des and Hilary. That was very useful. I think there's a huge amount in it as well. So thank you for that. We're just going to have a look at some questions very quickly that have come in through the chat. And the Q&A function. So the first question here for Des and Hilary: how are the banks acting in practice? And can the companies in a Scarp continue to use their own bank accounts?
I suppose the short answer, I say, and Hilary probably concurs, that yes is the answer, and that will be the experience in examinership to date. It's business as usual, and the company bank accounts, which are a critical part of the company's day-to-day operations, would remain operational. The banks are well used to the examinership procedure, and it will be the same under Scarp. If you're approaching or near your overdraft limits, you'd want to be careful of that, because the bank will be aware that you're undergoing a process. So that's maybe one thing to keep an eye on. But otherwise, no, I can only imagine you will only have the full support of the bank throughout the procedure.
Yeah, it's different from liquidation in that the process advisor doesn't assume responsibility for actually running the business. That remains absolutely the responsibility of the directors, whereas in a liquidation you'd be taking control of the business in that sense. So yeah.
That's great, thank you. Next up then is repudiation of a court. Is repudiation a court application made by the company or the process advisor?
So in that scenario, you'd have to engage legal representation, who would do that on behalf of the company, and the process advisor would be involved in an oversight capacity, but the application will be done by the legal team on behalf of the company.
Yeah. It'd be important for the process advisor, I'd say, if you're getting involved in that situation, that there's a couple of things that the process advisor needs to consider as to whether repudiation of the contract would likely be more advantageous for, say, the other contracting party, or they would have to decide whether the contract is burdensome to the company going forward, and ultimately decide or determine whether or not a rescue package can be put together in the absence of the contract being repudiated. So if it's the case that it's not going to work, if the contract can't be repudiated, then that needs to be considered, and that would feed into any court application, the determination of the process advisor.
Perfect. Just one other question. Is the process advisor or the company obliged to ensure guarantors are invited to the creditors' meeting, or who does this obligation fall upon?
Well, that's a good technical legal question, and what happens in the case of a guarantor is if the person that's holding the guarantee, the creditor, wants to pursue that guarantee, okay, they have to transfer any rights that they have to vote in a scheme to the person that has guaranteed the debt. So what will happen is the process advisor will send out his pack to the creditor, And within 2 days of receipt of the pack, the creditor, if they wish to rely on and enforce on the guarantee, must notify the guarantor, giving 2 days clear notice of the meeting and their intention to transfer the rights to the person who's guaranteed the debt to vote in the meeting. So the person who is subject to the guarantee then steps into the shoes of the creditor. He or she is entitled to vote for or against the scheme. That allows the creditor holding the guarantee to pursue the guarantee after the scheme. So the guarantee, it's the same as an examinership. It does, the Scarp can't defeat a personal guarantee.
So in simple terms, the process advisor has to write to all of the creditors. So the creditor must act on the correspondence immediately when they get it and take advice and issue the relevant notices. It's really important.
Perfect. Just very conscious that we're over time now. Just one final question: if you're now considering entering the Scarp process, what should you do now? What would be the first thing that you would encourage people to do now?
Well, engage an advisor immediately, even to ring a process advisor that you know, to even have a chat to, because you'll figure out pretty quickly whether or not your business is suitable. And if it's concluded that the business is suitable, then you need to get to work ASAP on your projections, understand what the funding requirement is going to be for the process, and to see if you have a line of sight on the investment, and then to go down through your list of creditors and see who will support and who you think won't support, because you need to get the majority over the line to support in order to get the process, to get a rescue plan approved. So the planning, planning is really, really important.
Perfect. Thank you, Hilary. I suppose just very conscious that we're out of time and we've run a little bit over due to the delayed start. But thank you very much to both Des and Hilary. That was very, very useful. Like we said, Scarp is still very new and it's still very much in its infancy. So we'll be keeping an eye on it over the next number of months and the next year as well. So, if you're looking for more information, please reach out to ourselves, to Des, to Hilary. Have a look on our technical hub on the Institute's website as well. And we've included just a number of useful links to various resources on our own website and also on the department's website and Revenue and the CRO as well. So thank you very much to Des and Hilary again. Thank you also to Dean Warren, who's our professional accountancy lead at the Institute, who's been key in the running of this webinar, and also to Chris, who's our program coordinator, running everything in the background as well this morning. So thank you very much.